two more slides here. We've got bad debt expense, another note here. So the following items are included in calculating bad debt expense for a certain period. The provision made each period throughout the year. So you do have a provision, which is an estimate, provision or estimate for bad debt expense, just like allowance, kind of estimate it, right? And then you have an adjustment made at year end to increase or decrease the balance in the allowance for uncollectible accounts if needed. So writing off a specific account receivable, this is still under the allowance method, but this is using bad debt expense in the allowance method. So when a receivable is formally determined to be uncollectible, the following entry is made. So there's no effect on net AR because you've already increased your allowance for doubtful accounts. Let me give you another kind of example here. So you've got AR of 2,000, and then let's say you made the journal entry because $50 is going to be uncollectible. You determined that. So under the allowance method, so on the balance sheet, AR is 2,000. You've made the journal entry now to do bad debt expense for 50 and allowance for doubtful for 50. Now what we see on the balance sheet is AR and then allowance of 50. So net AR is now 1,950. Cool. Now this journal entry, what we're seeing here is what happens. So at the end of the year, we just want our balance. We don't want this allowance stuff, right? So what we do is we now debit allowance to decrease that. So debit allowance for 50, and then we credit AR. So there's no net effect. So now we're reducing this by 50. So that's 1950. And now there's no more allowance. That balance is now 0. So net AR is still the same. This is what's going on. We're just removing it off the balance sheet. So remember I was talking about accumulated depreciation expense. That is done when you get rid of the asset. And this is done at the end of the year. Slight differences there. Awesome. What do we have last? Well, we have a couple more journal entries, some more bad debt expense. So subsequent collection of accounts receivable written off. So what about if you wrote it off, like we just saw, and then you actually, oh wait, you did collect it because they came back and said, hey, 3 years later, here's the money we owe you. Thank you for that. If a receivable is written off already and a company ends up collecting it, the reversal depends on which method was originally used. We're really just reversing out the accounts. So under the direct write-off method, we immediately wrote it off. As you remember, direct write-off, we directly wrote it off. So then we debit cash because we did receive cash, right? And then we credit uncollectible accounts recovered. That is the journal entry we'd use for the direct write-off method. Say be pretty good familiar with these journal entries. You could be asked to do them in Sims or in multiple choice. And then the allowance method, to restore the account previously written off, we're going to debit accounts receivable. So we're basically putting it back into AR and then removing it from cash. So we're kind of doing an extra step. We're debiting AR and crediting allowance for uncollectible accounts. And then we are debiting cash because it was actually received. So we're restoring the previously written off account. We're just backtracking, adjusting journal entries, right? Adjusting journal entries, redoing the whole thing here, and then actually recording the cash like we normally would as it should be if there was no write-off.